Hey, if you're looking to calculate the dollar amount of goodwill that needs to be put on the balance sheet after the acquisition of a business, then you've come to the right place. We have created a financial projection template built specifically for financial modeling for acquisitions of small businesses. And a big piece of that is calculating the dollar amount of goodwill that needs to be placed on the balance sheet after the acquisition. So I'm going to show you how to calculate that, how to use our tool to make that easy for you, and just explain the concept a little bit more as well. Hopefully in non-accountant speak, trying to make it easy for you. So first of all, my name is Adam Hooksum. I'm the co-founder of ProjectionHub. We have helped over 50,000 businesses over the last decade create financial projections for all sorts of different businesses and industries. And today we are focused on our acquisition financial projection template here, which I put a link to in the description of the video below, so you can go grab that and follow along that way. It'll be helpful for you as you are modeling out what this new acquisition is going to look like. If you need financial projections for an SBA loan, this will be really useful for that, or just for internal planning or potential investors. So, but really in this video, I'm just going to focus on the goodwill portion calculation. So first of all, why don't we just figure out what is goodwill in the first place? And this is really the reason I decided to create this video, is because I went and I Googled this and I just wanted to see what one of the top answers was. So Investopedia states calculating goodwill. It's calculated as the difference between the amount of consideration transferred from acquirer to acquiree and net identifiable assets acquired. General formula to calculate goodwill under IFRS is goodwill equals consideration transferred plus amount of non-controlling interest plus fair value previous equity interest minus net identifiable assets. Wow, that is a mouthful. I was an accounting major. I don't know what they're talking about in most of that. Now, I'm sure that is the proper CPA answer. But what I'm trying to do is trying to help the individual small business owner that's looking to acquire a business and just calculate goodwill in a simple, straightforward manner. So let me dive into how to do that. So we're going to come back to our acquisition template here, and you can see that we have this little green box called calculating goodwill. And what we say is after an acquisition, goodwill appears on a balance sheet. Goodwill is calculated by finding the difference between the purchase price of a business and the value of its net assets minus liabilities. Goodwill is an estimate of the value of the intangible assets of a business, such as name, brand recognition, customer list, etc. All right, so let's go ahead and show you how we can calculate this with our template. All right, so I'm on the input assumptions tab of our acquisition template here. And in order to calculate goodwill, you're not going to need all of these different assumptions here necessarily, but you're going to need these if you're creating a full financial model for an acquisition, which is what this template is focused on. I'm going to just go through these anyway. So we can put our company name, projection, start year, sales acquisition month. And what you're going to need to do now is fill out basic information on the current balance sheet. So let's say accounts receivable balance as of the acquisition date. What's the inventory balance of the business that you acquired as of the acquisition date? What's the accounts payable balance? So you put in the dollar amount balances of all of those. You also need to put in the existing debt that the business had prior to the acquisition. And the reason that's important is because what we need to really know is whether that debt was paid off in the acquisition or not. So see, we can put in, hey, there's a $150,000 SBA loan that the business had, but maybe in the acquisition, we're paying that off. Okay, maybe we're getting a new SBA loan and we're paying the old one off, and so we've selected yes here. But there's also maybe a small working capital loan of $30,000, and maybe the bank is allowing us to transfer ownership or just continue paying that during the acquisition or post-acquisition. So we've selected no there. So we're actually going to take on that debt in the acquisition. And then we have new loans that would be used for the acquisition. So you can enter in those assumptions here. And then equity investments that would be used for the acquisition or just for additional equity into the business. Then you'll need to add the existing fixed assets that you'll be acquiring in the sale. And what you need to do is enter the estimated fair market value of those assets when you acquire those. All right. And then for goodwill purposes, we don't actually need to worry about future purchases of fixed assets because that's in the future post-acquisition. All right. So once we've entered in all those assumptions, this table here is going to calculate goodwill for us. So we've got the fair value of the fixed assets that we're acquiring of $900,000. So that's just a sum of these right here. So $900,000 in value. And we've got accounts receivable of $36,000 that's been calculated by your assumptions above. inventory of $8,905. So we know our total value of assets acquired, $945,000. We have $5,000 of accounts payable, and we're assuming, remember that loan that wasn't going to get paid off? We knew that the balance of that loan was $30,000 as of the end of the last fiscal year or calendar year. And so what we did, since we were able to put in the amortization assumptions for that loan, we knew that, hey, by the time we acquired it, that balance is paid down to $25,407. So that's, again, a calculation, giving us a total value of liabilities assumed of $30,407. Now, we purchased the business for $1.1 million, but the value of the net assets, and the net assets is the total assets minus the total liabilities assumed. So the value of the net assets is $914,000. So what's the difference there? We're paying $1.1 million, but the value of the net assets is $914,000. That difference is your goodwill. And so that $185,119 is what is going to be added to your balance sheet post-acquisition. And so hopefully you'll be able to use this template, use this tool to enter in your own assets and liabilities for the company you're acquiring and be able to produce the calculated goodwill number. Now, if you have any questions, please leave a question down in the comment section of the video below or reach out to us at support@projectionhub.com and we'd be happy to try to help. Thanks.